Hello, everybody. I'm Scott Danner, CEO of Freedom Street Partners, and I'm coming to you for all of our Freedom Street Partner affiliates, all of our advisors, all of their clients, and anybody that's watching this great episode today of what we call our town hall, which is really about getting information out to our clients. I am really blessed to be joined by Scott Brown with his 28 years plus experience at Raymond James as a senior vice president and chief economist. He is a master of all things that we want to know. And I'm very grateful to have Scott here to share some updates on the economy, updates that I think are very timely for all of our client base and anyone else that's really interested in this topic right now. So Scott, without further ado, I will turn it over to you. I'm very grateful to have you. Thanks for sharing your time. And we're going to go through your slideshow and I can't wait.
Well, thank you very much. Greetings, everybody. I have been with Raymond James for a very long time now. I'm the answer guy on the economy. Look at sort of all the short-term economic reports that come out. I do longer-term forecasting, look at the Federal Reserve and so on. And at this point, I want to present some slides, talk really about where we are in the economic recovery, talk about the labor market, because that's a big part of the overall economy, with issues about inflation, Federal Reserve policy, and the budget deficit. Those are all the key questions that people want to know about. And we start, and I always like to take a look at the big picture. And we get quarterly reports on real gross domestic product. It's real GDP. So it's consumer spending, business fixed investment, residential fixed investment. There's some government consumption and investment in there as well, foreign trade, inventories. But the big part of the consumer spending is going to be consumer spending, which is about 69–70% of the overall economy. And it's real, meaning that we adjust for inflation. So rather than focus on growth rates, I think it's much better to look at the level of GDP to see where we've come from through this pandemic. And you can see beginning really in March of last year, we started to see the economy contracting pretty sharply. And just that March weakness was enough to push the overall quarter into negative growth territory. And then a huge drop in the second quarter, pretty good rebound, but only a partial rebound into the third quarter. And now we'll have the third quarter GDP numbers released soon, which will probably suggest maybe a slower pace. This may be the pause that refreshes that a lot of the third quarter weakness was due to the rise of the Delta variant. So that kind of dampened the improvement that we were seeing in consumer services. In addition, we've got these supply chain issues, most notably in motor vehicles, where the semiconductor shortage has led to a huge drop in production, a huge drop in sales. But some of that demand for autos is still very strong and may end up showing up next year if we can get these supply chains repaired in time. So, in the first or second quarter, we saw the level of GDP coming in and matching the previous level before the pandemic. But you're normally going to see GDP growing over time because the economy is getting bigger, population growth, and so on. So now you're looking at a forecast that has GDP likely to exceed the previous trend just within a few quarters. Obviously, there's a huge amount of uncertainty in this outlook. And a lot depends on what happens going on with the virus and everything, but it still looks pretty promising. Now, if we look at the employment numbers, non-farm payrolls, we lost 20 million jobs in the first 2 months of the pandemic. That is a huge portion of the population. And if you look at sort of these lower paying service jobs, 40% of those people lost jobs in just those 2 months. Now, a lot of them came back right away. Some of them didn't. And we're still seeing a fairly large number of people that are officially unemployed. And to be considered unemployed, you have to not have a job, but you have to be actively looking. And what we typically find is that a lot of people will give up looking at some point, and for a variety of reasons. It may be a stay-at-home spouse, maybe an early retiree, and so on. And so the unemployment rate tends to understate the weakness. And in fact, we were about over 5 million jobs short of where we were before the pandemic, but we probably would have added about 3 million jobs if not for the pandemic. So that's still a huge amount of ground to make up. But it's really curious because at the same time, you're getting these help wanted ads out there, very strong demand for labor. And this is sort of, I think, one of the big issues now for the economy is getting matching the unemployed people with the available jobs. It could be locational issues. You might have jobs available where there aren't people. You might have people available where there aren't jobs. If you think of the inner city and the working from home and everything like that, you may not need as many people doing the staff lunch crowds and things like that in the big cities. All those things are going to take time to clear up. We are seeing, I think, evidence that people are moving around a little bit more right now. So they are moving to where the jobs are. In some cases, particularly for the low-end jobs, those people may not have a computer at home. They may not have access to the internet. They may not know what kind of jobs that are out there. So there's an informational mismatch as well. But the demand for labor is still pretty strong, that there's still a lot of people unemployed. So it's kind of an odd mix. We've had some benefits, obviously, from the extended unemployment insurance, where it's not just people that have lost jobs, but typically people that don't receive unemployment benefits. It could be self-employed, people that are working part-time. Those people got benefits. And you saw a number of states in the summer starting to take those that federal assistance away. No real evidence that we're seeing that it's forcing people back into the workforce. So there is still a lot of hardship out there, but a very strong demand for labor at the current time. If we look at job openings, a huge surge over the last several months. It was down, I think, in August, but still pretty strong. Really much stronger demand for jobs than we were seeing over the last couple of decades. If you look at quit rates, people are not really excited. Particularly those at the low end of the wage scale, about going back to their old crummy jobs. So people are asking for wage increases, and they may not get them. But if you've got an offer somewhere else, people are going to jump ship. So we had more than 4 million people quitting their jobs just in August alone. And these are really historical high numbers. And data only goes back to the beginning of the century, just 2 decades worth. But these numbers are really quite outstanding. We're just hearing a lot of anecdotal evidence of this. Also a huge great wave. More than half, I think, of the people that have quit jobs have been early retirement. So they may be reluctant. There are issues still with fear of the virus. A lot of older people, maybe with some health issues, may not want to go back into the job market. So those people are quitting. You've got housewives where childcare. We thought at the start of the school year that, okay, the kids go back to school, you got child care issues, but the female labor force participation is going to be increasing. That hasn't happened. The child care is operating about 10% below the pre-pandemic level. So there's less of a supply of child care, and the prices have gone up, so it's more expensive for people to care for their kids. That female labor force participation, typically it is the female that stays home to take care of the kids, not always, but that female labor force participation is still pretty dampened as well. So all those things are kind of restricting a little supply of labor when the demand has been very strong. Now, a lot of this obviously has to do with the COVID cases. You can see the different kind of waves we had. Remember this spring of last year, that wave looks tiny. It was obviously concentrated in places like New York, certain parts of the West Coast. You had the summer wave. This is mostly kids, which are pretty healthy and less susceptible to the virus. And then this gigantic wave really towards the holiday season last year, where people were getting together. And we thought that, obviously this is going to dampen growth, but instead the number of cases dropped really sharply after the holidays. You did have the arrival of vaccines and so on, and that really boosted the strength in the underlying economy. So much so that the key parts of GDP, the consumer spending, we're looking at more than an 11% annual rate in the first half of the year. That's just huge. And then we had this Delta wave. The Delta wave, I think, dampened a lot of the improvement that we were seeing in consumer services. Now that's on its way out, so people are feeling a little bit more comfortable again. So we probably anticipate a pickup in growth following this Delta wave receding, much as we saw, after the wave at the end of last year. Now, one of the interesting things we have in terms of the changes in how the economy operates, working from home turns out to have been much more successful than anybody really thought. And this is probably going to stay with us for a while. So people may come back to the office, but it's not going to be nearly in the same kind of volumes that they did before. If you're a big company, have employ a lot of white collar workers, you can hire people from anywhere in the country. So we're getting reports now from places like the Midwest where a lot of firms from the East Coast are coming in because they can offer lower wages, and they're taking a lot of these jobs away that would normally happen in the Midwest. That's one thing. Blue collar workers, on the other hand, have to pretty much be where they work, and that's really kind of contributing to a lot of the mismatches now in terms of employment. The other interesting aspect is that, people couldn't spend money on services during the pandemic. They couldn't get on an airplane and go travel. They couldn't go out to restaurants or music concerts. You're seeing people going out to restaurants now, but not quite in the same manner as they did before. So not being able to spend on services, people were able to spend more on stuff. So consumer goods, we saw that demand really increasing. And we thought that as the economy starts to recover again from the pandemic, that you're going to see the services improve, and then the demand for goods would start to wane. But as it turns out, if you look at retail sales, in comparison to the previous trend, you're about 10 or 12% above that previous trend line, which is a huge increase. Now you see a little bit of a decline here in the last few months for the total. That's the motor vehicle story, where there's an issue with production. You're not producing as many cars. There are not as many cars on the lot, so the sales have been generally weak, down about 30% or so since April. But excluding autos, that trend is still really strong at this point. So we had direct deposits that went out in January, February. We thought that would be a temporary boost. I think we're still seeing signs that some of that was spent. A lot of it was saved. You see that in higher checking accounts, higher savings accounts that may end up helping spending going forward. Maybe actually prevent a decline. If somebody loses their jobs, they got more of a cushion to fall back on. But this is the one thing that may end up being longer lasting. There's just this huge demand for stuff. And this increased demand for stuff comes at a time when we've got these supply chain disruptions. So with the supply chain issues, it's not just pandemic related bottleneck issues. There are manpower issues. Look at the ports of Los Angeles and Long Beach, where we get about 40% of the container traffic coming into the U.S. And it's not just being able to unload the docks, but being able to take what's being unloaded and shipping it. So it's the rail and the truckers and so on. And that's really gotten to be a key bottleneck on the East Coast. A lot of ships are coming in, and the ports just really can't handle the flow through. And there's a port in South Carolina, which has really more of the capacity to just stack containers around. And a lot of that stuff is just being placed short term. So there may be issues, particularly as you head to the holiday shopping season. There's going to be a lot of stuff. Typically, the demand is going to be strong for a lot of goods for the holiday shopping. And maybe a lot of it doesn't show up on time. If you're a dad, don't wait until the last minute, as usual. You need to be proactive. And if you haven't shopped already, you should probably start soon, because we think that's really going to be a bit of an issue. But again, the increased demand is adding to the supply chain issues, and that's putting upward pressure on prices. So if we look at core inflation measures, we throw out food and energy, not because food and energy don't matter, although food and energy are both seeing some pressure right now. Energy for a variety of reasons. For food, for a lot of the production in terms of mostly meat, there are a lot of issues with those. Jobs are really kind of unattractive. It's hard to find people. Those people may not be, the available workers may not be where the jobs are, and so on. So we're seeing a sharp rise in inflation. You can see the PCE price index is a lot like the consumer price index. That's the Fed's chief goal, to get that to 2% over the longer term. And they've been pretty much operating under that over the last couple of decades. So the Fed actually announced a change in its policy regime where it wanted to push inflation higher. The problem is in the short term, you've got all these pandemic related issues with supply and demand. So the Fed had really kind of seen this as being transitory in nature. But there are two big concerns. I mean, you've got all these supply chain issues, you've got all these labor issues that are still going to be with us now for a while. These supply chain issues have really been a lot more severe than we thought they were going to be at the beginning of the year. They've lasted a lot longer. They've been more intense. Now look like they're going to last into the early part of next year. And for the Fed, the danger is that the higher inflation, if it persists, these supply chain issues, labor issues, and so on, then it starts to affect the inflation psychology. So if people expect higher inflation, they're more likely to ask for bigger wage increases. Firms are more likely to try to pass higher costs along. And then inflation expectations start to ramp up. And this is kind of the story we tell about the 1970s, where you had the oil price shocks, and that led through to higher inflation overall, and then higher wages, and then the higher wages in turn added to inflation. So the expectations really play a key role. There's a debate going on currently at the Fed and amongst economists in general about how much inflation expectations really matter. And again, inflation expectations may not be a really good predictor of actual inflation, but it's the idea of the mentality of inflation and the fact that we're getting fed inflation on the nightly news. Consumers, certainly, you see it at the grocery store, you see it at the gas pump. It's a topic of discussion, and so that inflation psychology could end up moving higher. In terms of where this inflation has come from, we started to see obviously a huge increase in sort of the monthly numbers back in the spring of this year. Some of them pandemic related. You had a drop in prices during the worst part of the shutdowns in the spring of 2020. So you're going to see a rebound. We call these things base effects. So some of the prices that were down are now going to be higher. We're seeing real issue with motor vehicles. The new car, in terms of the semiconductor shortage, the used car, well, last year you had a drop in production, and because of the drop in travel, you didn't get the rental agencies buying as many cars for their rental fleets. And then this year, they're not dumping as many used cars back into the market as they normally do. So there's a shortage of used cars, just as people are starting to recover from the pandemic. So the huge demand for vehicles, that led to a real sharp boost in used car prices. Even car insurance, parts, all those things kind of went higher. But you can see if you throw the motor vehicle stuff out, you throw the pandemic related stuff out, then the inflation numbers have been more modest in the third quarter. So that's good. But again, you've got all these pipeline pressures. Raw material prices in general have started to come down, but we had a huge increase over the last year as those flow into intermediate products. There's still some inflation there and still seems to be building. A lot of that supply chain issues, distributional issues. So this is certainly, flashing yellow, if not red. They're watching all these inflation indicators pretty closely. Now, for the Fed, again, as I mentioned, the inflation expectations really matter a lot. You can do surveys of economists. You can do surveys of consumers. Those have been sort of rising. You can go to what are called market-based measures of inflation. That's the tip spread, the spread between inflation-adjusted treasuries and regular treasuries. And you can kind of split that up into sort of the 5-year outlook and then the 5-year outlook 5 years from now. And what you see is this huge increase, obviously, in the short run. And again, that's reflecting the changing issue with the supply chain still being disrupted, and that likely continuing into next year. The longer term outlook has gone up, and it's been sort of at the top of its recent range. And we had a big concern back in spring when this was rising, but it's not too terrible. It's still below 2.5%. So this, I think, bears watching pretty closely. But because of these inflation concerns, you're seeing an issue where the markets may be worried a little bit more about Fed policy. And with Federal Reserve policy, we've got two big issues. One is the tapering of the asset purchases, and the other is what we call liftoff and short-term interest rates. Now, large-scale asset purchases. The Fed, typically in a recession, in times of need, the Fed will lower interest rates to increase the amount of liquidity in the system. Well, you're kind of stuck at zero. The other central banks have lowered short-term interest rates below zero, have negative short-term interest rates. Fed doesn't want to do that. So you can't go lower below zero. So what you do is what are called large scale asset purchases. It functions a lot similar to cuts in interest rates. So the Fed goes out and buys a huge amount of securities, principally Treasury securities, mortgage-backed securities. And throughout this pandemic, the Fed's been buying 120 billion per month. That's a lot. And 80 billion per month in Treasuries, 40 billion per month in mortgage-backed securities. So this is really a fire hose of liquidity. And it's been pretty clear for some time that the Fed doesn't really need to just be pushing this amount of liquidity in the system, but you don't want to stop cold turkey. So the Fed's been very careful. It started early in the year where the Fed wasn't even talking about it. And then they started talking about it. And then they started talking about it. And now it looks like at the meeting next week, they're probably going to announce that the tapering will begin relatively soon. It might be delayed until the mid-December meeting, but most likely, I think people expect this to start right away. And we think this is going to be a reduction of about 18 billion in that monthly pace per month. So about 10 billion less in treasuries, 5 billion less in mortgage-backed securities each month. So it'll be stepping down, tapering down, and it should reach zero by the middle of next year. So June or July, the Fed won't be adding to the size of its balance sheet. Fed's not making any statement about reducing the size of its balance sheet, only that it's going to be stopped adding to it. And that addition, this liquidity, these asset purchases, have found certainly, I think, partly at least some way into the stock market. So that's been helping to fuel share prices, has been helping to push bond yields down. So there may be some disruptions, but again, I think a lot of this should be factored in by the markets by now. This shouldn't be a surprise to anybody. It should be fully factored in. The other issue, and it may end up mattering more to the markets, is what we call the liftoff in the short-term interest rates. Now, the Fed target is currently between 0 and 0.25%. We don't really know when the Fed's going to raise rates. In fact, the Fed is not even discussing when they're going to raise short-term interest rates. That may come. But the market-based measures have been moving forward. At every other Fed policy meeting, there's what's called the dot plot, and each dot represents an individual forecast of a Fed official. It could be a Fed governor or one of the 12 district bank presidents about where the appropriate federal funds rate target is going to be at the end of the next few years. And what we've seen is, during the most of this crisis, the Fed was not expecting to raise short-term interest rates this year, next year, the year after that. So not all the way through 2023. Now, those dots have gradually increased. So at the previous Fed meeting in September, half of the Fed officials were expecting to raise rates at least once by the end of next year. Since then, we've seen these inflationary pressures become a little bit higher. The market-based measures of liftoff have moved forward. In fact, most recently, we've seen the federal funds futures market pricing in greater than an even chance that we'll see at least one rate increase by June of next year. So that's a lot earlier than people thought before. I suspect it's very likely that the Fed will raise rates at some point next year. I think they may be still a little bit reluctant, but obviously there's a lot of pressure. And the key issue here for the Fed is sort of this balance between the job market and inflation. A lot of the inflation issues are temporary in nature, but a lot longer that they last, then that means that they could end up being more significant. So, again, I think the Fed probably wants to increase that, but the Fed also has to worry about the job market. And in particular, something the Fed learned a few years ago is it did all these town halls and talked to professors and market mavens and so on, is that the low unemployment rate is especially beneficial to communities of color, low-income communities. And so that's very much on the Fed's mind. And unlike other central banks, which just have an inflation target, the Fed has to balance the sort of the job market versus the inflation outlook. But ultimately, if they don't want to see inflation getting out of control. Now, again, they've changed their framework for monetary policy, and that previously the Fed has always acted preemptively to head off inflation. They raise rates sooner to keep inflation contained, and that increase in interest rate ends up slowing the economy down. And many of the recessions we've seen has been essentially caused by the Fed raising rates too fast or too soon. So it's a very, very dicey situation. The new framework says that they're going to wait until inflation actually shows up. Well, they're not convinced that the inflation we're seeing now is sort of what's going to be happening over the longer term. But again, there's this fear of inflation expectations starting to heat up and so on. So, maybe they split the difference and start to raise rates, but pretty slowly beginning next year. If you look at Treasury budget, that's another big issue. We've had a huge amount of consumer spending or government spending associated with the recession. And if you remember the financial crisis, we had a huge amount of spending as well. The deficit ended up being about 10% of GDP, 1.4 trillion. And then as the Great Recession faded, the financial crisis faded, the revenues started to come back, and the spending, recession-related spending decreased, and you ended up with lower deficits. And then it started to increase again, and we were looking at a deficit on the order of around $1 trillion, 4.7%, 4.6% or so of GDP, which is, it's kind of like Reagan era, 5% of GDP. That we can live with that, but you probably want to have lower deficits as a percentage of GDP. And in fact, we've gotten up to around 18% of GDP. And this last fiscal year, which just ended in September, was about 12% of GDP. So the budget deficit over the last fiscal year. But next year, it's forecasted to come back down to about 4.7%. A lot depends on how rapidly the economy improves, but certainly the tax revenues have been coming back. This was a big worry, particularly for the state and local governments, where during the financial crisis, all these state and local government budgets were under pressure. And so, you had to have serious cuts. A lot of cities cut firemen, police, and so on. In this case, we thought initially that could have a repeat of that, but because of all the spending on stuff, the tax revenues have done generally pretty good at the state level. But in terms of the fiscal policy, it's going to come down. You do have the infrastructure spending, which may come out soon. We don't know. There are two parts to it, and they're probably going to try to pass them simultaneously. And you divide it up into the hard infrastructure, which is the roads and bridges, things like that. Certainly, we've needed a lot of that for a long time. Both parties have been supported. The big sticking point is how you're going to pay for it. There's been a sort of a sea change in terms of how the Democrats view the deficit. Previously, when Democrats have been in charge, they would have pay-go rules, which means that if you want to spend more on something, then you've got to find cuts in something else, or you have to have ways to raise taxes. That's gone out the window now. The Republicans certainly are very willing to increase the deficit if it involves tax cuts, but increased spending, they're not really excited about that. So you don't have any Republicans on board with the hard infrastructure spending. And then with the softer infrastructure spending, that really, I think, plays a lot more into sort of the long-term growth aspects for the economy. You're talking about increasing childcare, which is going to boost female labor force participation, more workers, more consumer spending, more jobs, and so on. So all that would be very positive. Early childhood education would help prepare the workforce down the line. So a lot of these things are going to take a real long time to pay off. Research and development. The government's really kind of underinvested over the last decade or so in research and development compared to past decades. So if you boost that, that would help the overall economy improve. But it looks like a lot of that stuff is now really getting watered down quite a lot. A lot of the harder infrastructure spending, again, is spread out over 10 years. So it may add a little bit to GDP growth. It may add a little bit more to the budget deficit in the short term. But it should help the long-term prospects for the economy. Now, what about the federal debt? Are our kids or our grandkids going to have to pay this off? No, they don't. The federal government is nothing like a household. The government does not have to pay off the debt. It only has to make interest payments and be able to roll over the existing debt. And at this point, in comparison to, say, previous decades, think of the 1980s where, you had all these deficits year after year after year, and the budget deficit or federal debt doubled as a percentage of GDP. at the end of it. And people were started to worry, particularly the Japanese, which were a big buyer of Treasury securities, started to balk at that, and the Treasury yields started to rise. And that was largely because, global investors had alternatives. You had the German economy you could invest in, you had the Japanese economy. Well, Japan's bubble burst. Germany is now part of the European Union. Nobody's real excited about that. So the demographics in Japan certainly have not been very favorable because they don't have any immigration and the aging of the population there. Europe is sort of behind Japan, and we're, I think, a little bit behind Europe. But that aging of the population is going to be a serious factor. Now, when you look at the federal debt, a big part of this is the 28, 29 trillion or whatever. Most of that is what we call marketable debt, and the rest, this difference, is the debt that the government owes itself. How can that be? Well, government has these trust funds, Social Security, Medicare has some retirement funds that are in there, government retirement funds. And the idea is that the baby boom generation, beginning in the 80s, has been paying into these trust funds. And now the baby boom generation is retiring and tapping into these trust funds. You take these trust funds down. So what's going to happen is this marketable debt is going to be rising as a percent of GDP. Well, the federal debt may end up being relatively stable, and that's because of the shift from into marketable debt, the fact that you're tapping into these trust funds. So I don't really lose any sleep. There's no magic level of the federal debt that's going to lead to either runaway inflation or a crisis. Again, the U.S. government is still considered the best bet for government debt for global investors. That may change over time. Not clear what would take our place. Certainly Europe, probably not. The UK, probably not anytime soon. China, perhaps, but China has a lot of issues. It's not really a currency that is free floating. It's still very much a structured economy. So all of this suggests that we need not worry too much. And in fact, the thing that I worry about more is that we're going to try to do something about this. So you try either to raise taxes or cut spending, and that ends up contracting the economy, making the recovery weaker, and so on. So bigger picture, longer term, we've got these issues. And I love this chart because it sort of looks at where potential GDP is coming from, and it's labor times the output of that labor. So labor productivity growth and the growth in the labor force. And you can see, back in the 70s, baby boom generation was coming into the workforce. Female labor force participation was rising at a pretty sharp rate. You had some loss in productivity growth because of the oil shocks. But you can see that the labor force growth has been slowing down. The baby boom generation is now heading into retirement. Female labor force participation is more or less topped out compared to where it was in the 70s. It can go up, I think, another few percentage points if we get more child care issues taken care of. But you've also cut immigration. So you're looking at a much slower growth in the labor force. Productivity actually may end up being a little bit better. One of the things we're seeing now with the pandemic, particularly the first half of this year, is a very strong pace in capital spending. And if you look at the non-defense capital goods orders and shipments, pretty much trending flat more or less over the last decade. Well, it's on a tear right now. And those expenditures really help to boost productivity. You're going to see a lot of changes in terms of technology. Robotics, I think, are really amazing now. So you're talking about self-driving cars, self-driving trucks. So a lot of the labor force issues, you've got 3 million people that are maybe driving trucks in the US. Those people could be doing other things. And, there are difficulties in sort of transitioning over time, but those kind of improvements suggest that productivity growth may end up being stronger. So that's one way to offset the slower labor growth going forward. So I think that some of that signs that we've seen in business investment has been very encouraging recently. So that's pretty much the sum of it. There's a disclaimer for those that need it. And let's turn back to the other Scott, and maybe we're going to have some questions.
Two Scotts. It's always good to have good data and good information to help our clients their friends and their family all make the best decisions they possibly can. All right, Scott, we're going to do some questions, and I think we took in a lot of questions from our clients. The first question that seems to come in is really about inflation and the confusion between the negative or positive correlation of the stock market. I think everybody seems to get confused as to where the best place to put their money is when inflation's happening, because it's been something that people have forgotten about. And so help us understand that, help our clients understand that a little bit better.
Yeah. A lot, I mean, the correct answer is it really kind of depends on how big inflation is going to be, how much of an issue it's going to be going forward. And there are sort of two key issues. One, trying to hedge inflation. Well, commodities have typically been a good way to hedge against higher prices, although commodity prices have risen pretty substantially due to prices of raw materials. They're up a lot. And over time that, you may see the supply of raw materials increasing and coming back down. Gold has been always thought of as a traditional hedge, maybe not so much anymore. As an asset class, it's not like a stock that pays a dividend. It's not like a bond that has a yield. If you buy just gold outright, it's worth whatever the next person is willing to pay for it. And in the short term, if enough people are worried about inflation, the price of gold is going to rise. You can buy gold mining stocks, which you actually do have a yield associated with that. There's gold in the ground that is going to fluctuate in value, so that may make a little more sense. But there's only so many gold stocks you can buy, and so typically, when there are issues in the stock market, people try to pile into a lot of these gold mining stocks, and so you'll get very significant fluctuations in price there. You can buy inflation protected securities, but you're going to lock in a loss at this point. The Treasury, inflation adjusted Treasuries have a negative return. Even the bond market itself, you look at the 10-year Treasury, and it is below what anybody would consider as a likely inflation rate over the next 10 years. So there aren't that many places to go. For the individual stocks, a lot depends on if they're able to pass higher prices along. And, if that's the case, then, if your costs are rising 5% and your selling price is rising, 5 or 10% maybe, then that's not going to be an issue. If not, and you can't raise prices, then margins start to shrink, then that could be an issue. A bigger concern may be if the Fed really messes up here and inflation ends up being a lot more longer lasting, not just a year, but 2 years, maybe 3 years. And then the Fed's got to tap on the brakes to slow the economy down to get inflation back under control. And it's that raising interest rates that is, likely, could induce a recession, which is going to be a negative for the markets and so on. So it's a very dicey kind of environment. I think having a diversified portfolio certainly always makes sense in this kind of environment. Depends on your individual risk tolerance and so on.
Yeah, it's great to hear. The arguments usually come back to a great asset allocation, being diversified across a broad spectrum of markets and understanding that, there are ups and downs every single day and every year, but spread out in the right capacity for the goal that you have at hand really tends to be the best strategy. A big one we keep hearing is the stock market's been good for so long. Are we in a bubble? And I think you answered this throughout the presentation, but just in simplified terms, the question that a lot of clients ask, and the one that I have in front of me from multiple people who have asked it is, how long does it continue before there is a big setback? And I don't know that people are afraid of a correction. I think a correction is normal, and everybody kind of gets used to the 10% correction territory. It's where it dips past that, and we might dip into that recessionary number.
Yeah, I think certainly 10% correction, 20% correction, those kind of things are going to happen over time, and they're actually pretty healthy for the market to kind of clear things up. And we've seen, I think, when the market does go down, you see a lot of buyers stepping in to prop it back up. So that demand for securities is still pretty strong. When you look at valuations, you look at sort of earnings and earnings price ratio, and that's going to be inversely related to longer term interest rates. So if interest rates are low, the 10-year Treasury, being 1.5, 1.6% or something like that, then we can have higher PEs. If that long-term Treasury rises to 3.5, 4%, something like that, then the earnings per share ought to be coming, or the price to earnings ratio should be coming down, unless earnings are rising much more. No, we've had just incredible growth in earnings throughout the pandemic, and that may likely slow down. I don't think the market's really expecting this phenomenal growth in earnings that we've had over the last year to continue forever. It's probably going to be a mixed bag across sectors, across time. So, it's going to be a little bit maybe a rotation here and there, and that's typically what happens. And again, an occasional downturn is going to be welcome in terms of it's healthy for the market that happens. Longer term, I think you still bet on the success of the U.S. economy. A lot of political issues, obviously, to be considered about. And one of the big issues we're hearing now, obviously, is what's called TINA. There's no other alternative. I don't want to overstress that, but the fact that the U.S. still looks like a good place to invest. Europe is probably going to do okay, post-pandemic, but it's not really setting the world on fire in terms of their overall economy. China obviously is a big question mark. A lot of issues with investments going on right now. The rest of East Asia, I think, looks pretty good. It should benefit as the pandemic is put behind us. A lot of mixed reactions in terms of what's going on with the rest of the world. We find that vaccines obviously aren't being evenly distributed through across countries. The countries that have been more successful having better economic results, those that are imposing vaccine mandates are having stronger economies and so on. So it'll be a bit of a mixed bag, a bit of a jumble, I think, looking at the rest of the world. But the U.S. is still going to be the place to be, especially for U.S. domestic investors.
So two fun questions to end, and one is a lot of people are looking to buy vehicles right now, and the semiconductor shortage is creating a problem. I know I've dealt with the same thing. These are great problems to have for those of us that are looking to purchase a new car. But the question is, I have asked this of multiple people over the course of time. When do you see the semiconductor crisis kind of waning a little bit and this type of thing being evened out to a more
I think one point is you want to stress that the supply chain issues, production bottlenecks, we see this in every economic recovery. This time they're on steroids because the demand for stuff is so strong, and because of the pandemic related issues, we've had real issues restarting. You've got labor force issues and so on. With the semiconductors, I think the experts are telling us that it's still likely to continue into the early part of next year. And it's not just the autos, there are a wide variety of things that have chips in them now. So that's going to be a bit of a concern. There may be some pressure to push or pull back a lot of the semiconductor production into the US. Those things will generally take a bit of time. So, if you're a car dealership, then, you're going to be, not giving as many discounts as you normally do to clear the lots, because the lots are already clear. If you're looking for a particular model, it's going to be pretty difficult, and you may end up having to pay up for it. So these things, I think, are going to be with us for a while.
Yeah, you look at the savings rate that's gone up by so much. I mean, some of it was forced in the sense that people couldn't spend any money. And now you saw your retail chart where it kind of shows that there's been a surplus of people kind of getting out there and getting the money back into the out of their wallets, if you will.
Yeah, I think you sent these deposits, checks or direct deposits in the first quarter, went out in January and March. And I think a lot of the surveys suggest that a lot of people just banked those. They didn't go out and spend them. In some cases, they did. So for people that didn't have jobs, that was very critical support. But a lot of that is still floating. When you see it in the size of the checking accounts and savings account, a lot of that is likely to be held back. I mean, people were kind of shell-shocked by the pandemic. And typically, it takes time. People are going to be reluctant to spend that money. really until the pandemic is well behind us. And it does take a lot, just a certain fraction of people to have that sort of behavior.
Right. Well, I think the last question I'll hit you with is, a lot of clients have kids that are getting ready to enter the college years and looking at, and the college years can also be the workforce years if they choose not to go to college. But if you're looking and you're playing the role you often play with the markets and the economist side, where are you advising the next generation to go and study to really take advantage of the next decade of opportunity?
Well, I think you need a sort of a broad education. You've seen in the past people specializing in one particular thing and maybe having a little bit more broader experience, minor in something as well as majoring in something. Because I think what we'll find is that, people will change jobs, and not just employers, but in terms of what they do, and they may end up reinventing themselves in terms of different jobs over time. There'll be new jobs that come along that we don't even really understand right now. We can't even predict. That's typically what happens. So that really exposure to a wide range of things, I think is better preparation for what could come next.
Yeah, that's great. I mean, look, every great technology innovation must be marketed. Every technology innovation and marketed technology also has to have a leadership team. And there's so many different roles within a company that and careers that we don't even understand yet. So Uber was not a thing when we were going to school at any point in time. And so it's kind of unique to see the world change. Scott Brown, Senior VP with Raymond James, Chief Economist, great advocate for all the information for us. We're very grateful to have you. Thanks for answering our questions. And thanks again for your time today.